5 is where we are at with a 15-point mild up move. Taher Badshah is our market master today. He's Chief Investment Officer, Equities at Invesco Mutual Fund. Taher, great to have you with us here. What markets we live in and are witnessing, right? Big, massive moves, especially in the US, and some consequent moves here as well. Mutual funds are getting handed a lot of cash. Last month also, inflows into mutual funds were the highest, were some of the highest. Are you deploying right now, Taher, or are you waiting? Are you cautious? Tell us, how are you looking at the whole situation?
Also, I've been kind of, conveying this for some time now that, to 2023, at least to me, looks to be a difficult year from a market perspective. And therefore, to that extent, I mean, while we are amongst the flows and, the industry has been once again seeing some recovery as far as flows is concerned, we are moving in reasonably, cautiously. I don't really see any hurry to get into the market in a big way, except barring a few pockets where probably, if the declines are very sharp and then it throws up some specific investment opportunities, either from a valuation perspective or from a growth standpoint, then that's fine. But otherwise, in general, I don't really think there's a market where we need to probably hurry into or rush into, very soon.
Taher, hi, good morning. So you don't want to rush into this market very soon, but the play this year has largely been on fixed income, and 9 out of 10 asset allocation strategists recommend that perhaps this is a good year to be raising your allocation in fixed income and going slow on equities. Would you do the same? And what is the best approach for the year now, given all the challenges that we have upon us?
So you're right, Sonia, that we are thinking almost alike, and we do really see a situation where probably fixed income, at least from a tactical standpoint, maybe for a year or so, provides a better investment opportunity. We at least get into those specific pockets, whether it is in the maturity curve between 0 to 3 years or 3 to 5 years, which does provide reasonably decent YTMs in any case. I mean, we can lock ourselves into something like 7.5 plus on quite a number of products around this maturity curve, and probably look forward to a possibility of getting some kind of capital appreciation at least in the middle of 2024, if not anytime earlier. So I think those yields look relatively more attractive, and that part of the curve is something which provides an opportunity compared to the longer end of the curve at this stage. From an equity standpoint, I would say that, well, like as I said, there doesn't seem to be a rush to get in, and therefore the best investment strategy probably as far as equities is concerned is to think of this year as an opportunity from the point of view of gradually building your portfolio, not with the expectation that returns will come into 2023 itself, but this is the year as probably the market grinds down a little bit, or probably we go through a bit of time correction. That will be a time when you build onto your investments, you make your product choices and asset allocation, and look for returns essentially for 2024 and 25.
Taher, hi, good morning. That's a sobering thought, especially given that you're saying that with the market 10% down from the peak. And I think it'll also be a great lesson for a lot of the new investors who came into the market in 2020, right? This is not a one-way ride. So can you expand on that thesis? So you're saying you wouldn't rush in now, 10% down from the peak. At what levels will that change? I mean, what sort of further correction or valuation levels would you really go all in, let's say? Until we get to that point, how do you start building the portfolio? What parts of the market are you comfortable with? How do you build for, let's say, FY 25, 26?
So great question, Surbi. What is running through my mind, at least, and this is what probably I've been kind of maintaining for the last few months, is that we're probably going to see the lagged impact of interest rate hikes, which happened around the world as well as in India in 2023. I mean, it'll manifest in probably certain idiosyncratic ways, like it has happened in the case of some of the problems that we witnessed in the banking sector in the US of late, or probably in the form of actually a slowdown. I mean, consumption-led slowdown, both globally as well as we already essentially started to see signs of it in India in any case. So I think this will be the year of that, readjustment that we will probably go through. What was probably supposed to happen or was expected in 2022 might actually unfold in 2023. So I think that is the reason why I say that you're better off being a little slow in terms of your allocation, or probably from the point of view of your money into the market. I think India faces a bit of a extra challenge that we have been at the higher end of the curve as far as valuations are concerned, probably brought upon because of our significant outperformance in 2022. So I think we are probably starting to give up some of that. We're seeing that in the last 3-6 months that we are somewhat, a little more under the weather than probably some of the global markets. And the third thing is that we are witnessing, we've actually had a lot of our growth actually come from one part of the economy, which is consumption, and that to high end, mid end consumption. Bulk of the growth has been driven by that. We've not really seen much at the bottom end of the pyramid, and we don't really see much of levers that is probably going to change, especially in an environment where interest rates are probably going to remain elevated for some time. I think the part of the market which I still like is the one which is associated with the industrial cycle, the manufacturing cycle, the investment cycle. I think that is where probably the surprise element to my mind for domestic investors as well as global investors alike is going to be a little higher compared to what it is probably on the consumption side. I think that is a more undiscovered part of the India story, I would think, compared to probably the consumption part.
Okay, just one final question then from my end. And by the way, the market now is starting to fall a little bit. So let's just, not take our eye off the screen. The Bank Nifty is now down 150 points. The Nifty may not show it so much, but beneath the surface, there is quite a bit of damage. The mid-caps as well are down over 100 points. Just before we let you go, Taher, do you foresee a situation where the cuts could get much deeper from here? I mean, are we looking at a large-scale sort of recession playing out globally and taking most equity markets down with it, perhaps even more than a 10-15% fall? Could that be your base case?
No, that's not my base case at this time.
Okay.
I mean, like as I said, I mean, some of these, the impact of interest rate hikes in the world will somehow manifest itself in somewhat unacceptable forms during the course of 2023. But will it be of the type which will probably take down growth substantially? I don't really think so. I think, and in that context, then probably India has a better chance because you still have one part of your economy which is doing quite well, which is the manufacturing, industrial investment part of the economy. So I would like to at this stage think that we are down. Yes, you rightly said we are down about 7-8% from the peak, and what I'm probably expecting is a somewhat similar magnitude of correction, maybe going forward as well. So you end up another 7-8% lower at that point in time. You even correct in terms of your valuations, and investment opportunities probably become open up at that stage. So I'm not really looking at very deep cuts in the market to precisely answer your question.
All right,
but this will be a year when the market will drag, and it'll kind of be completely indifferent. We'll probably see a combination of time and absolute correction, I guess.
Okay, a boring market, right? Maybe.
Yeah,
I dare say, which is worse than a falling market to some, but it is not, to be fair. Thanks very much, Taher. Great to have you with us here. It's always a pleasure speaking with you.
I think people would take a boring market any day, Prashant. People would prefer a boring market to a falling market, I assure you that.
Do you guys remember the market from, I think, it was 2010, all the way, we made